Today, we are going to do financial markets, part 2. Now, what are we going to learn in this? In this, we'll understand money market and the instruments traded in the money market. Now, what is money market? Money market is a part of financial market. So, financial market has got two parts, money market and capital market. Money market is for the short term and capital market is for the long term. So, in this, we are going to study money market, from where the various business houses, they can raise money for the short term, that is up to 1 year. So what are the features of money market? It's of course the market for short term funds, and the period of maturity of these funds is 1 year. And here the securities are very liquid because you can get it converted into money within 1 year. And because you can get it converted into money within 1 year, therefore the risk is also less, and it has no physical location. Just like we buy online shopping. So when you buy goods online, you don't know where exactly the seller is. So there's no physical location. Similarly, money market does not have any physical location. And most of the activities are either conducted through the telephone or through the internet. Like we buy goods online through the internet, similarly. And the major participant here is RBI. There are banks also, but the major participant is RBI. And because of RBI, money market has a lot of credibility. And even mutual funds are being traded here. Now, there are 5 instruments in the money market: treasury bill, commercial paper, call money, certificate of deposit, and commercial bill. Now, let us study it one by one. Let us study what a treasury bill is. Treasury bill is also called T-bill. Now, what happens when the government of India, they need money for the short term? So, therefore, they tell RBI to issue treasury bill. RBI issues treasury bill on behalf of the government of India for a minimum amount of 25,000 or its multiple. That means 25,000 or 50 or 1 lakh, like that, multiple of 25,000. And what the government of India does is they sell these treasury bills either to the bank or to the general public. And these treasury bills mature within 1 year and they are issued at a discount. For example, there's a treasury bill of 1 lakh, then you will get it for 98,000. And after the expiry of the time, you will get 1 lakh. So they are issued at a discount, but it is issued by RBI on behalf of the government of India. So let's do the features. Now, treasury bill is also called T-bill. It's also called deep discount bond or zero coupon bond. And they're issued by RBI on behalf of the central government. Minimum amount is 25,000. And there are promissory note. They're highly liquid and negligible risk because it is being issued by RBI. And it is always issued at a price less than the face value, and they're redeemed at par. And this is a source of short-term borrowings by the government. So money market is all about short-term loans and advances. So the first instrument of money market is the treasury bill. Then come to commercial paper. Now, commercial paper is exchanged between companies. Now, suppose company A has got surplus, and for a short time, maybe their consignment had to come. They were awaiting a consignment from England and it's going to come 2 months late. So they've got the spare money for 2 months. And company B is running short of cash. They need cash for working capital requirement. For a very short term, they need cash. So company B has got 2 choices. Either company B can go to the bank and apply for a loan, or they can ask company A to give them the money, that surplus money they have for 2 months, and then return it. Now, company A and B are known to each other. Suppose company B goes to the bank, then the bank has their own set rules and regulations, and fixed interest is charged. But if company B goes to company A, asks company A to loan them that money for a very short period of time, then in that case, the interest is also much less and the rules and regulations are also minimum. So the help that company A gives to company B during the time of shortage of funds, it is called commercial paper. Company A issues commercial paper to B, but they will issue it only to B if B is a credit-worthy company. Suppose B takes the money and doesn't return it, then A needs the money after 2 months. So where will they get the money from? So therefore, A will issue this commercial paper only to that company which has credit-worthiness. And this means of transfer of money from one company to another is called bridge financing. And it is for seasonal purposes or working capital purposes, and sometimes even to incur the expenses of flotation cost. What are the features? Of course, it is for short term because they are coming under money market. Now it has a fixed maturity period. Now company A did not have money forever. They had only for a short period because for that particular period, they didn't need it. So they said, okay, you take it. If you need it, you take it. Because company A feels that if today B needs some money and we'll give him, tomorrow we may need it. So they will also give us. And it is issued by large and credit-worthy companies. Only those companies which have credit-worthiness, which have got a goodwill. Otherwise, what if they don't return? Then normally the maturity period is between 15 days to 1 year. Because it is short term, it has got to be less than 1 year. And it is again sold at a discount, just like Treasury bill. And it is used for seasonal and working capital needs. During particular season, like in case of farming, during harvesting, they need a combined harvester, then packing, and then marketing. So for a very short period of time, they need money. So for working capital or seasonal purposes, this means of short-term borrowings is used. And it is also used for flotation costs. This is a very important point. This commercial paper is also issued to cover the flotation cost, because when you raise equity, then the cost of raising capital is quite high. And then it is also called bridge financing, just to bridge the gap between a very short period of time. So this is called bridge paper, bridge financing also. Then come to call money. Call money is also called interbank money or telephone money. Now, what is call money? Now, RBI, as you know, is the apex bank. They keep changing the CRR. CRR is cash reserve ratio. They keep on changing. So this is the amount of cash that the banks have to keep. So they keep on changing it. Sometimes they increase it. So when they increase it, the money available with the bank to give as loan becomes less. So in this situation, let us say a bank B has got surplus, but bank A is running short of cash. They need cash. So what bank B does is, bank B asks bank A to give them money for a very short period of time. Sometimes it's only 1 day, so as to tide over that period. So bank A gives the money to bank B, and this money is called call money, but they charge a huge amount of interest. That is called call rate. Because if bank A gives the money to bank B, then bank B has the money. But what happens if bank A starts running short of cash? Then in that case, the interest rate that they're charging is so high that the bank B has to return the money to bank A as soon as possible. So whenever a bank needs money, RBI immediately reaches the money to that bank. But sometimes it takes time. So to tide over that period of maybe 1 day or 15 days, the one bank borrows money from another bank just to tide over the period, because RBI has changed the CRR, that is cash reserve ratio. So let's study in detail. Now, call money is also called interbank money or telephone money, because they just pick up the phone and they ring up. जैसे आवाज मारते हैं ना कि आना जरा, तो आवाज मार के कुछ सुन के आ जाता है. So nearby bank they ask. Then it's for short term, and sometimes it is for 1 day also, and up to 15 days, because no bank can spare money for a long period of time. Then RBI keeps on changing the CRR. And because of the CRR, the funds available with the bank to distribute as loan becomes less. And if people come to take loan and you don't have the money, then you need it. So normally the bank asks the RBI, but to tide over that small period before RBI can actually reach the money to you, they take it from another bank, which is called call money. So the banks borrow from each other to maintain this CRR. And the interest that is paid, no bank will give you free. They'll charge interest. So this interest rate is called call rate. And it is very highly volatile. It keeps on changing. Suppose you say, I want the money only for 1 hour. But then after 1 hour, you don't return. Then they increase the interest rate. And there's an inverse relation between call money and other short-term money. Because interest rate keeps on increasing, then the other short-term means look much cheaper. Then comes certificate of deposit. Now what happens is, when we put our money in the bank, suppose you put your money for a long period, it's called FD. When the company puts the money in the bank, it's called CD. C for company, C for CD. CD is certificate of deposit. Now, why is there a difference between the money that we put in and the money that the company puts in? What's the difference? What's the difference? Now, what happens is, during certain time, the demand for loan is very high. Like for example, during Diwali, people want to buy new things. They want to buy a car, maybe a house, television, big television they want to buy. So they go to the bank for loan. So the demand for loan is very high. Now, by giving loan only, the bank earns their income. So the bank wants to give loan, but they don't have cash. They don't have liquidity. So during the times when the bank has low liquidity, but the demand for loan is very high, what they do is they they issue CD to the companies. They tell companies to put money with them and they'll pay maybe slightly little high rate of interest. So the company have surplus money. So there are wealth managers in the bank who request the company to put money in their bank account. And when the money comes to the bank through deposit, then from that they give loan. So when they give loan, they earn interest, and from that they can pay for the CD. So this is called certificate of deposit. So banks issue CD during the times when the liquidity is low. Liquidity means the cash available with the bank is low, but the demand for loan is very high. People are asking for loan and the bank doesn't have cash to give as loan. So therefore, during those times, the bank issues certificate of deposit. This is issued by the banks either to individuals or corporations. So let's study the features. It's also called CD, certificate of deposit, CD. And it is unsecured, negotiable, it's for short term, and it is issued by commercial bank and development financial banks. Basically the commercial banks issue it. And whom do they issue it? They can issue it to the individuals or corporations or companies who have surplus money. They want that money to be parked with their bank, with the bank for maybe a short period of time only, so that the bank tides over that time when they have less security and demand for loan is high. And during the period of tight security, when the deposit growth is very slow, people are not depositing the money, they're asking for loan, demand for credit is very high, that is the time when CD is issued by the bank to individuals or corporations. Then comes commercial bill. Commercial bill is nothing but bills of exchange. So when the seller, that is the drawer, sells goods to the buyer, who is the drawee, he draws the bill and the drawee accepts it. After the drawee accepts the bill, it becomes a bill of exchange. Now this bill of exchange is with the seller. Now if seller needs money, he needs short-term finance, then this bill is with him, he can get it discounted with the bank, with his own bank. So when he discounts the bill with the bank, it becomes a commercial bill. Commercial bill is nothing but bills of exchange. So what is a commercial bill? It's a bill of exchange and it is used to finance working capital, that is short-term. It is short-term self-liquidating instrument. And it is used for credit sales. Remember the drawer and the drawee, that is on credit sales. So the seller draws the bill and the buyer accepts it and it becomes a trade bill. And when this trade bill is discounted by the drawer with his bank, it becomes a commercial bill. So these are the 5 instruments traded in the money market. I hope you have understood them well. Now let's tackle the case study. Again, we'll first see what we're looking for. Now we have studied 5 instruments. Name the money market instrument the company can use for this purpose. So one of them is being mentioned here. What is the duration and what are the other purposes? Okay, so we need to identify which instrument it is. So I'll read the case study and you think about what we are talking about. Shriya Limited is a large credit-worthy company manufacturing automobiles in the Indian market. It now wants to cater to the other market and decided to invest in new machines. For this, it requires long-term finance. It decides to raise funds by issuing equity shares. The issue of equity shares involves huge flotation costs. Little bit of hint is coming our way. To meet the expenses of flotation costs, the company decides to tap the money market. Now the question says, name the money market instrument the company can use for this purpose. Now we have got 5 instruments and we can go through them quickly as to which one fits the bill here. So I'll give you a moment to think about it and then I'll share the answer with you. Yes, you've got it correct. All 3 answers are related. So let's check out the answer. To meet the expense of flotation cost, that is commercial paper. Commercial paper is specially issued to meet the expenses of flotation cost. So the answer is commercial paper and the duration of the commercial paper is 15 days to 1 year. And it can also be used for seasonal and working capital needs of the business. So I hope you've got it correct. That's it in this video. Thank you.